Prabhat Awasthi, Head of Equities with Nomura India, joins us. Prabhat, good morning and thank you for joining us. Prabhat, we are off to a slow start this year. Where are all the allocations? Where are the FIIs? Typically, beginning of the year is all about fresh allocations and new capital allocation.
Well, I guess the money is going to developed markets, and I think from India's perspective, I think most of the people will wait for the big event, that is elections. That is the country-specific event that is keenly awaited by all investors. And obviously, this is important. This is an important event this year because the state of the economy. So there is clearly a direction that economy and investors are seeking, and there is a contingent big event. So I guess you'll not see that much inflow. And depending on the election outcome, I think you probably will see, market taking a direction, at least in the short term.
Prabhat, about 2 months back, a whole lot of market participants were fairly confident of a very strong pre-budget rally, and levels of 7,000, 7,200 as well were being talked about in the index. Now with the emergence of the Aam Aadmi Party and perhaps the possibility of a third front government or a hung parliament, do you see that view getting challenged, and does it seem like it's going to be a very narrow range bound sort of move for the market up until the elections?
Well, I think the momentum or positive views that you're referring to basically are formed when the market is moving up. I mean, these sort of views have a self-fulfilling way of getting reinforced by the market participants. So our target for the March is 22,000. We have sort of stuck to it because there are challenges for the economy. So just getting very bullish only on the change in political front is something that will probably not sustain. Now, clearly, Aam Aadmi Party has surprised people, given the strength they have shown in Delhi. But I would say this, that there is no concrete, opinion poll which sort of gives you a fresh look at how the next election is going to pan out. And I would also say that our market has, in the last 2 elections at least, I think has found it very hard to forecast election results. I mean, end of the day, 2004, the market went down terribly, and 2009 we had a massive up move, and tells you how good the market has been in forecasting elections. Now, people will form views. They will have clearly sort of. So I think every news flow out there is analyzed and absorbed by the market. But I think at this point in time, in the absence of any fresh opinion poll, it's very hard to say how things will pan out, and there's still a very long way to go to elections. So I think going into election, that uncertainty is always there, and therefore a massive up move going into elections is unlikely, and it's quite likely that you'll see volatility post-elections. Right. But economy has its own path, and you have to buy at the right price for that path that is currently there.
So, which is my next question, Prabhat. Should one really wait for the election outcome? Because if the outcome is strong, this market will be circuit up. If the election outcome is bad, this market will be circuit down. I mean, this market will not give you a great entry or an exit after the election verdict.
I'm not sure about that, actually. In fact, I would argue that if you look at the market move this year, Nikunj, it has largely been technology, pharmaceuticals, those kind of stocks. So the move we have seen in the market has been very defensive. So you can argue that from the bottom, some of the capital goods stocks have risen, but year-to-date performance is hardly anything to write home about. So I don't think you are essentially saying that we've built a very large recovery into the marketplace. Market is optically looking very high, but you strip out the exporters, and I don't think you'll be anywhere. That is the first point. The second point is that even if a new government comes, which is right for the market, let's say, the fact is that we are in a slow growth environment. The government will have to grapple with a lot of challenges on fiscal, because clearly there will be a lot of bills to be paid from this year, next year. There is just no room, and in fact, if there is the government right mind will start to correct fiscal, there will be a slowdown. There will be a slowdown in growth that cannot be corrected in the very short term. So my point simply is that a hope multiple that people talk about from the new government might not last too long. So if the market rallies 20%, it might be time to sort of trim your positions and wait for a better entry point. So my point simply is that the growth outlook of the market is unlikely to change, in the short term. In medium term, yes, as the policies come through, but there is a price that you will pay for the hope multiple. Maybe 5%, 10% goes up, 20%. I don't think it will make sense, even if there's an eliminated government, to continue to hold on to the market positions.
Prabhat, whereas you've given me your March target for the Sensex, do you have a target in place for 2014?
We think that it not be when we started last year, we didn't actually have more than required rate of return for the market. The target was 22,000, but it was not enough actually. This year, I think, might be a better year for the markets, because the number of headwinds that we were battling last year were much higher. We had a current account problem, we had a massive inflation problem, we have a growth problem. Some of these issues are sort of turning to be behind us. So despite the fact that there is very little to show by the way of growth in the economy, and our view is that it's not likely to be all that great even going forward, we think that market will be, your returns will probably be better in the range of about 15% and that is that's not assuming any political upside or downside risks. That is based on the currently available information as to how the economy's path is. But a very eliminated government could enhance that somewhat, and a fractured mandate could actually obviously bring down these. But I still think that despite whatever the government might do, given the state of the economy, I think some of the healing that economy has seen will probably stay in place. The fact that current account deficit has come down, that inflation is coming down, that there is very little fiscal room to do any more populism, are all factors which will support the market at a particular level. And finally, global growth is picking up, and as I said in the beginning, a lot of the performance has come from these stocks, and they're continuing to deliver on earnings. So that also provides a downside support to the market. So I think if you look at the risk reward in the market over the next 1 year, I think it is much better than what it was last year.
Prabhat, let's talk sectors. IT really has, been the star all of last quarter. This quarter as well, we're seeing that trend pick up. First it was Infy, then HCL Tech this morning, and expectations are it's going to be a strong lot from TCS too today, or rather later today. Do you think IT will continue to be one strong leg of the market, even, up until elections, next 3 months?
Well, I think we take 1 year calls, and I think we have been overweight on IT, and we continue to be overweight on IT. There is nothing changing with the fundamentals. Fundamentals are getting stronger as US recovery takes hold. Europe actually recovers from the slump it was in. So global growth clearly is in the favor, especially the markets in which IT services, Indian IT services, that they are getting better. And the fact is that there is no particular headwind in terms of wage pressures, etc., given the state of the economy in India. So I think they are definitely in a sweet spot. Valuations are not very adverse, so they might be. There is no particular reason to get bearish on IT at this point in time. In fact, I think these are sectors which was the sector of last year, probably remain the sector of next year as well.
So, Prabhat, on top of a good 2012 and a great 2013, do you still think that large cap IT stocks can give double-digit returns, or now to generate double-digit return on a CAGR basis would be difficult for IT stocks?
Well, double-digit is 10%, and I think earnings are growing faster than that. So if you do not see a negative multiple contraction, as I said, you're likely to see the earnings rate return at least, and there is no reason to suspect that at this point in time, there's no reason to expect that earning multiples will shrink. So I think they can give double-digit returns for sure.
If I glance through your overall earning assessment, you expect sales to go up by about 2 to 3%, and you are betting on a margin growth. Now, typically when sales are coming back, margin growth is coming back, that marks some kind of an earning bottom. So at Nomura, are you of the view that the worst of the earning print is behind us, and the earning trajectory now for coming quarters is only going to go up?
Well, I think earnings are stabilizing, Nikunj. I mean, the fact is that as I said again, there is a large component in especially Sensex. If you were to look at this IT, there's Reliance, there's oil and gas sector, there are metals, there is pharmaceuticals, there's consumer. Consumer is more domestic, but a lot of these companies are actually export oriented or have prices, the product prices which are linked to benchmark to global prices, and that's a very, very large chunk of total earnings. So when you actually look at the economy and you try to make an assessment of the market, sometimes you fail because the market is more representative of a lot of global stocks and not always representative of the Indian economy. So I think that is where the Sensex starts to decouple, and earnings also in that sense start to decouple from the global local market conditions. I think the earnings growth will be reasonable. Maybe about 10-12%. The expectation, I must say, are for a bit higher earnings growth for next 2 years. The consensus expectation for Sensex, for example, are closer to 15% CAGR, and which is higher than the CAGR of last 3-4 years, when the economy was doing better. As I said, global economy is picking up, so there might be some headwind provided from that source. But I think a 15-16% CAGR is still on the higher side. Maybe 10-12% growth in earnings is quite likely, or is possible, or let's say, over the next 2 years.
Prabhat, the one stock which really was on a runway was Coal India yesterday. Of course, reasons for that, the dividend boost that the stock got. But do you think now with the fiscal year to wrap up just in 2 odd months and the government's deadline pretty much running out on, raising the deficit, do you think we will see more dividends and special dividends from some of these cash-rich miners, and thereby names like NTPC as well would get more attractive?
Well, I think the fact is that they are falling behind on disinvestment targets, so they would like to take out money from cash-rich PSUs. That clearly seems to be the reason why the Coal India dividend was so large. Now, it's very hard to speculate as to which PSU will be, but I would say that, for example, NTPC needs a fair amount of cash because they're investing. Coal India does need cash, but the amount of cash they throw up compared to what they use, there was probably a case for taking it out. So I think it's a case-to-case basis, but I would agree with you that in general, the PSUs which have cash and the cash needs which are much below that could likely be looked at as a source of financing the current year's deficit.
Okay, price breakout in Yes Bank. So banks have trended up very smartly. Now, Yes Bank NPAs were not all that, NPAs have gone up. So the earning profile because of the non-fee income was strong, but NPAs, at least for Yes Bank and for IndusInd Bank, the two initial numbers they've come out, they have not come down. In fact, they have gone up. Another pocket which I want to address is the entire telecom space. Across the board, telecom stocks have come down. They've come down on strong volumes. Bharti, we've already identified for you that technically it's looking like a weak stock, at least for a day trader.